It's funny, isn't it? There's just so much investment advice out there everywhere you look.
Oh, absolutely. It's overwhelming.
Yeah, and trying to make like genuinely smart long-term decisions feels well harder than ever almost. You hear all these conflicting things, people promising secrets.
Mm-hmm.
It's just tough to know how to get well informed without your head spinning.
That feeling is so real. And all that noise, it can actually make you freeze up, Analysis paralysis. Or, like you said, chase after things that just don't pan out.
Exactly. So look, in this deep dive, we're trying something a bit different. We're going back to basics almost. A foundational idea kind of hiding in plain sight. That could really change how you think about building wealth long term.
Yeah, think of it as a lens, maybe. A
Yeah.
simpler way to look at strategy.
Right. A powerful but surprisingly simple lens.
And the core of it really comes down to low-cost index fund investing. Now, I know that doesn't sound like the most exciting headline ever,
Yeah, not exactly thrilling.
but honestly, as we dig in, you'll see just how big a deal this seemingly simple approach can be for your financial future. It's quite profound.
Okay, so that's our mission then. Let's unpack why this simple strategy works so well for the long haul and really how it can make a real difference for you.
Let's do it.
All right, let's get into it. And maybe the best way to start is with that story. The tale of two brothers.
Ah, yes, William and Edward. Our source uses them perfectly to show the two sides of the coin, the silent killer of high costs versus the magic of compounding returns.
Right, so both brothers, William and Edward, they start with the exact same amount, $1,000 bucks. And over 50 years, they both get the same average return, 8% a year. So you'd think, okay, similar results, right?
Logically, yeah, but that's not what happens.
Not at all. Edward, he picks a low-cost index fund. His fees are tiny, just 0.2% per year. So over those 50 years, his $1,000, it grows to about $43,200.
Wow.
That's that compounding magic, just quietly doing its thing.
Okay, so what about William? Same starting point, same 8% return.
Exactly the same. But his fund charges 2% in annual fees. Now, that sounds like a small difference, right? 1.8% more than Edward?
Doesn't sound huge day to day.
No. But after the same 50 years, William's pot has only grown to about $18,700.
Oof. Less than half of Edward's.
Yeah. Identical market luck, but less than half the wealth. That's a really, gut-wrenching example of what the source calls the tyranny of compounding costs.
Tyranny is a good word for it. It's like this slow leak year after year, those fees just draining potential growth, and the gap just gets wider and wider.
It's staggering. That small 1.8% fee difference cost him over $24,000 in the end.
And that really drives home how vital it is to pay attention to those costs, even if they look small on paper. They're anything but small over time.
Absolutely. Okay, so fees are critical.
Yeah.
But when people think investing, they often think stocks, and then they think, oh, volatility risk.
Right, the roller coaster aspect.
Yeah. And our source tackles that head on. It makes the case for why stocks, despite those bumps, have historically been the place to be for long-term growth.
That's right. Look, short-term ups and downs, they're absolutely part of the deal. Nobody denies that. But if you zoom out, the historical data, say from 1926 to 2016, tells a really compelling story.
What does it show?
Over that long stretch, stocks gave an average annual return of around 9.5%. Bonds, more like 5%. And cash, barely kept up with inflation, around 3%. Now, obviously, past performance doesn't guarantee future results,
But those are massive long-term differences.
it's huge, especially when you factor in compounding over decades.
The source had that example, right? Putting $10,000 into a total stock market index fund way back in 1926.
Yeah, a fantastic illustration.
And despite everything, the Great Depression, World War II, Black Monday, the dot-com crash, 2008, I mean, all of it.
All the major crises.
That 10 grand still grew into millions by 2016. It really makes you think about just stay the course.
It really does. It shows the underlying resilience, the growth engine over the very long term. And the beauty of a total stock market index fund is it just captures all of that automatically. Broad diversification.
Okay, so the point isn't just betting on stock prices going up randomly. There's something more fundamental happening.
Exactly. The source makes a really key distinction. Long-term investing isn't speculation on price wiggles. It's about investing in the growth of actual businesses.
Right. When you buy a stock or a piece of an index fund, you own a tiny slice of real companies doing real things.
Precisely. And the long-term returns come from those businesses succeeding, growing their earnings, becoming more valuable, maybe paying out dividends.
Like Coca-Cola, for example. As they sell more Coke around the world, make profits, maybe pay dividends,
Yep.
That success contributes to the return of an index fund that holds Coca-Cola stock.
Exactly. So by owning a broad index fund, you're essentially, as the source puts it, casting your lot with business as a whole. You're aligning yourself with overall economic growth, with innovation, with companies creating value.
You're not trying to pick the one winner. You're betting on the whole team, basically.
That's a great way to put it. You're participating in the general progress.
Okay. But then comes the big temptation, right? Sure, indexing is okay, but I want to beat the market. Shouldn't I find a smart manager who can pick the best stocks?
Ah, yes, the allure of active management. It's a very common thought, and the source dives right into it.
And what's the verdict?
Well, the data is pretty sobering, actually. The source highlights that the vast majority of actively managed funds, we're talking around 80%, consistently fail to beat their benchmark index over the long run.
80%. Wow. That's
Yeah.
a lot higher than most people probably think.
Yeah.
Why? Why is it so hard for these pros to beat the average?
It comes down to a few key things. First, as we saw with William, active funds just cost more, much higher fees, often 1%, 2%, sometimes even more. Compare that to index funds where fees can be, less than 0.1%.
Okay, fees are a big
A
hurdle.
huge one. Second, active managers trade more often, buying and selling. That racks up transaction costs, another drag on returns. And third, there's investor behavior. People tend to chase performance pile into a fund after it's had a hot run, then sell out when it hits a rough patch, buying high and selling low.
That classic mistake.
Exactly. And it erodes returns significantly. The source even mentions a study, I think it was 1986 to 2006, where the average active fund returned up about 10% a year. But the S&P 500 index did almost 12%.
And that's before you even properly account for the higher fees on the active fund.
Precisely. Once you subtract those higher fees, the underperformance gap gets even wider.
So it really highlights what the source calls the grand illusion, this idea that paying more gets you more.
It's an illusion for most investors, yes. The odds are heavily stacked against it.
Okay, but what if a manager does have a good year? What if they beat the market by, say, 2%? Doesn't that make the fees worth it?
Well, you have to look at the net return. So your manager beats the market by 2%, great. But if they're charging you a 1.5% fee...
Ah, right. You're only actually ahead by 0.5%.
Exactly. And meanwhile, the low-cost index fund that just tracked the market minus its tiny fee might give you a very similar or even slightly better net result with way less risk of falling massively behind. Sustained outperformance after fees is incredibly rare.
And it's not just the management fees you see up front, is it? There's another hidden cost. Taxes.
Yes, absolutely critical. Taxes. Active funds, because they trade so much high turnover, tend to generate a lot more taxable capital gains each year.
And those gains get passed through to you, the investor.
Right. You get hit with a tax bill, often annually, which eats into your overall return. Index funds, on the other hand, tend to buy and hold, much lower turnover.
So fewer taxable events. You defer the taxes until you actually sell way down the line.
Precisely. It's much more tax efficient. More of your money stays invested and compounding for longer. The source uses an example of an active fund with 100% turnover versus an index fund. The tax impact difference can be really significant year after year.
Okay, now what about the future? We hear a lot about maybe lower stock market returns ahead compared to history. Does that change the equation for indexing?
That's a really important question. The source acknowledges this possibility. Maybe future returns average 6% or 7% instead of the historical 9.5%.
So if returns are lower, does indexing still make sense?
Actually, the source argues it makes even more sense. It becomes even more critical.
How so? That seems counterintuitive.
Think about it. If the overall pie, the market return, is smaller, then the slice taken out by fees represents a bigger proportion of your potential return.
Ah, okay, so a 1.5% fee hurts more when the gross return is only 6% than when it's 10%.
Exactly. That cost advantage of the low-fee index fund becomes proportionally larger. The gap between the net return of the index fund and the high-fee active fund actually widens in a lower return world. Costs matter even more when returns are modest.
Gotcha. Okay, so we've established picking winning stocks is tough. Most active funds underperform after costs. But what about picking winning sectors? Trying to figure out if tech or healthcare or energy is the next big thing.
Another tempting strategy, but again, the evidence suggests it's mostly futile. Relying on past performance to pick the next hot fund or sector is notoriously unreliable.
Things change too fast.
Yeah, and mean reversion is a powerful force. Funds or sectors that outperform massively for a few years often tend to fall back to the pack or even underperform afterwards.
The source had that example, didn't it?
Yeah.
A top fund from the late 90s.
Yes, A top 10% performer during the dot-com boom, then bam, bottom 50% in the early 2000s after the crash. Chasing heat often leads to getting burned.
And the same applies to whole sectors, right? They rotate in and out of favor.
Absolutely. Trying to predict those rotations consistently is incredibly difficult. Think about the dot-com bust again people piled into tech just before it collapsed. A broad index fund avoids that concentration risk. It just owns the whole market, letting the winners naturally emerge over time.
Okay, this all naturally leads to thinking about financial advice. If active funds and sector picking are so tough, what about getting help from an advisor?
A valid question, and the source offers some caution here. It warns against automatically trusting advisors who might push high-cost funds.
Why would they do that?
Well, sometimes it's because those specific funds pay the advisor higher commissions or other incentives. Their interests might not be perfectly aligned with yours.
So it's crucial to understand how an advisor gets paid.
Absolutely. The source suggests looking into fee-only advisors. They charge you directly for advice and are generally obligated to act in your best interest. Or, for many people, simply using low-cost index funds directly can be a perfectly good and much cheaper approach.
And the cost difference between those routes can be huge over time.
Oh, massive. The source shows scenarios where the difference between using a commission-based advisor pushing expensive funds versus just buying low-cost index funds yourself can amount to tens, even hundreds of thousands of dollars over an investing lifetime.
Right. So if there's one single message hammering home from this source,
Yeah.
it really is keep costs low.
That's the absolute bedrock. It's the most significant factor you, as an investor, actually control. You can't control market returns. You can't predict the future.
But you can control what you pay in fees.
Exactly. And the source points to Vanguard as a sort of pioneer in this low-cost philosophy.
Yeah, they get mentioned specifically.
Their focus on driving down expense ratios really changed the game. And the source, again, shows the math, even a difference between, say, a 1% fee and a 0.1% fee on a $10,000 investment over 30 years. It's tens of thousands of dollars difference in your pocket. Small leaks sink big ships over time.
So given all this, the source advocates for, what was the phrase? The majesty of simplicity. I like that.
Yeah, it's a great phrase. The idea is, for most people, the best path is often the simplest. Just own a single, super low-cost, broadly diversified index fund, like a total stock market fund or an S&P 500 fund.
It's almost countercultural, isn't it? In a world selling complexity, the answer is simplicity.
It really is. You get maximum diversification, minimal costs, and you avoid the temptation to constantly tinker or chase rainbows. It helps you stay disciplined for the long run.
And this low-cost indexing idea, it's not just for stocks, right? Bonds, too.
Absolutely. The same logic applies. Bond returns come mostly from yield, so high fees are particularly damaging. Low-cost bond index funds give you broad exposure and generally outperform active bond funds over time. Same for money market funds for your cash. Keep those costs minimal, too.
Now, the source also mentioned something called enhanced index funds. A warning there.
Yeah, a bit of caution. These are funds that tweak the standard index weighting. Maybe they overweight value stocks or small caps, trying to get a slight edge.
Sounds clever.
It can sound appealing, but they almost always charge higher fees than plain vanilla index funds. And there's really no guarantee these enhancements will consistently deliver better net returns after those higher costs. Often it just adds complexity and cost without a reliable benefit.
Okay. And what about ETFs? Exchange-traded funds. Everyone talks about those. Low cost, right?
They can be very low cost, yes. And they offer easy trading. But that ease of trading can be a double-edged sword. The source warns against using ETFs for, like, rapid-fire trading or market timing.
Because that racks up costs and defeats the purpose.
Exactly. Trading costs, potential tax consequences. It can negate the low expense ratio benefit. For a long-term buy-and-hold investor, sometimes a traditional index mutual fund is just as good, maybe even better, because it encourages discipline.
It's fascinating to think about what historical figures would make of all this. The source speculates about Benjamin Graham, the father of value investing. What would he think of indexing?
It's a great thought experiment. Graham was all about depth analysis, finding undervalued stocks. But he was also massively focused on minimizing costs and diversification, the margin of safety.
Right.
So the argument is, given how hard true value investing is for the average person and how crucial low costs are, Graham would likely have seen low-cost indexing as the most sensible, practical approach for the vast majority of investors today. It aligns perfectly with his core principles.
So when you strip it all away, it comes down to, what did the source call it? The relentless rules of humble arithmetic.
Yes. Humble arithmetic.
Break that down simply.
It's just this. Your final return, the money you actually keep, is whatever the market gives you, gross return, minus whatever it costs you to invest, fees, taxes, trading costs.
Nate Rose costs. Simple as that.
Dead simple. And because active strategies inherently have much higher costs, the math just makes it incredibly difficult for them to consistently deliver better net returns. Index funds win by minimizing the minus costs part of the equation. They let you keep almost all of the market's return.
This has been really, really clear. So, okay, pulling it all together from the source, what are some practical things listeners can do, like right now?
All right, practical steps. First, think about your overall plan, your asset allocation. How much in stocks versus bonds? A common starting point is the age in bonds rule, but tailor it to your own risk tolerance and timeline.
Okay, get the big picture right first.
Yeah. Then, for implementing that, look seriously at using low-cost, broad market index funds for both the stock and bond parts of your portfolio. Keep it simple, and probably the most important thing, adopt a long-term mindset. Ignore the daily noise. Resist the urge to constantly trade or react to headlines. Stay the course.
So the big takeaway really is just the incredible power of cutting costs and keeping things simple for building wealth over the long term.
That's the core message. Focus on what you can control those costs and let compounding do its work for you, instead of having high fees work against you.
It really forces you to think differently, doesn't it? If the biggest single factor predicting your long-term success is something entirely within your control, the costs you pay, what steps are you going to take starting today to actually take control of that?
That's the question to ponder.
Something to definitely think about. We really encourage you to explore these ideas further, maybe even check out the source material we've been discussing. Thanks for joining us on this deep dive.